The question here is how do stock markets or stock exchanges, how do they work? And of course, the stock market, the stock exchange represents, the backbone of investing. You can't invest without stock exchanges. So in this context, stock exchanges they are centralized platforms, where buyers and sellers, they meet to trade financial securities such as stocks, bonds, derivatives, and other related asset classes. So they play a crucial role in the economy by providing a structured kind of marketplace for investments. So here is an overview of how our stock market functions. We want to see precisely how stock markets and how the market functions. Number one is listing companies. This is a very important function of the stock market, listing companies. And so companies, raise capital through initial public offerings or IPO, offering shares to the public in exchange for funds. They want to raise capital. They come to the market, with the help of a broker, and then raise the desired capital to expand their operation, and of course, to fund their overall activities as a company. And not only that, to be listed, companies must meet criteria, set by the exchange, including financial stability and disclosure standard. They must disclose their financial returns regularly, and they must do that transparently. That's why the market is there. The exchanges are there to facilitate all these activities. Number two is trading mechanism. Trading mechanism. So stock exchanges, match, buy, and sell orders through automated systems based on price and time priority. The market is there. The exchanges are there to match, buy and sell mandates. And not only that, buyers offer a price which is called the bid, and sellers sets a price which is called the ask. When this match, a trade occurs. And so market makers provide liquidity by continuously buying and selling securities. So we have a group known as market makers. They are there in the market. They are there in the exchanges to do what? To facilitate, buying and selling. They provide liquidity by providing a continuous flow of stocks in the market for sale, and they equally, provide buying power for those that want to sell. And by so doing, they maintain a kind of efficient trading mechanism in the markets. Number three is market types. Market types. So when we talk about the market, essentially we are dealing with different components we want to highlight in this particular point, and that has to do what is called the market type. So in this case, the primary market is where new securities are issued. You have the primary market as well as the secondary market. The secondary market is where existing securities are traded among investors. When a company wants to raise capital, they come through an IPO or other related means. That represents the primary markets. So for the existing shares to be sold, then of course they have to come through. It is conducted through the secondary markets. You want to buy shares, you go to the market and you buy. You want to dispose your holding, you go to the market and then you key in your sales, your sales order. Number 4 is price discovery. Prices are determined by the forces of demand and supply, influenced by company performance, market sentiment, as well as economic factors. These are the key factors that influence stock market. The prices of companies in the market First of all, their financial performance, and then the prevailing economic conditions, as well as the forces of demand and supply, and also investor sentiment. Investor psychology equally play a role. When there's too much greed in the market, people tend to buy, and when there's panic in the market, the sentiment of fear comes in, people sell their shares. Please subscribe to this channel if you've not done that, and like this video. Drop a comment in the comment section, and I believe it will do me a ton of good. Number 5 is regulatory oversight. The market actually is there to provide regulatory oversight. Exchanges are regulated by government bodies, like the SEC in the US, and also in Nigeria you have the SEC. As they are there to ensure transparency, they ensure fairness, as well as guarantee investor protection. They are there to cater for the welfare of investors by shielding investors against pyramid schemes, against fraud, fraudulent activities, and other related vices in the market. Number 6 is clearing and settlement. Clearing and settlement. Clearing ensures both parties fulfill their obligation after a trade. Whenever a trade is executed, several parties are involved, and those parties fulfill their obligation as it relates to the executed trade in the market at that particular point in time. So settlement transfers ownership of securities within the seller, the seller to the buyer, and funds from the buyer to the seller within the stipulated days. All right. So they make sure that the buyer gets his shares, is allotted the shares, and then the seller is given is able to get his money in the process. That's what clearing and settlement entails. The seller gets his money, and the buyer gets his shares, and that is done within the stipulated range of days. Number 7 is a technological infrastructure. Technological infrastructure. So modern exchanges, they use advanced electronic systems for trading. But if you look at documentaries of exchanges in the 1920s, 30s, they use the ticker tape to trade. There was little of technology in the entire process, but now everything is done electronically, and it's even done faster. You see, and so it's also guaranteed. It enables speed. Everything is done at the speed of almost like speed of light, and transactions are carried out. Almost at there's that global accessibility. So a typical example here is the NGX in Nigeria, the NSE, and the Nasdaq in the US. And so they provide the technological infrastructure that guarantees that yes, trading is done effectively and efficiently in this day and age. Number 8 is role of brokers. So investors trade through brokers who act as intermediaries, offering advice, managing trades, or providing direct market access. There's a video I did about the rules of the role of brokers. You could source for the video in this particular channel. That will give a detailed breakdown of the roles of brokers in the market. Number 9 is facilitating economic growth. So stock exchanges help companies, raise money for expansion. They raise money for expansion, and they provide investment opportunities for individuals and ensure liquidity. More importantly, they ensure liquidity. You can buy anytime you want to buy. You can also sell whenever the need arises, and it is done seamlessly because of the liquid nature of the market. And not only that, they contribute to economic stability as well as growth. And a modern economy cannot thrive without a vibrant stock market. The stock market actually detects the pace of the economy, and the economy equally influence activities and returns in the stock market. The two cannot do without each other. And this structure approach ensures an efficient and transparent marketplace, benefiting both investors and the broader economy. And so this is exactly how the stock market works. It provides a backbone, for the investment process. There's no investment process without the stock markets. And all countries have stock markets, if I'm not mistaken, and the institution is there to make sure that the economy runs seamlessly.